President Bullard, it's Sarah Eisen. Good to have you back on the show.
Hi, Sarah.
At what point do you need to slow down QE, including the purchases of corporate bonds? How are you thinking about that?
Yeah, I think, I'm with the chair here. We're not even thinking about raising rates. And I think we've got a good policy in place right now. I just continue this policy. I don't really think this is about monetary policy. This is about the virus and the economy adapting to the virus, the risk management around the virus and the contagion that would otherwise occur. I think our monetary policy is just right for this situation. We're have a low policy rate. We're going to stay low for a long time. Markets expect us to stay low for a long time. We're encouraging market functioning through the purchases, but also through the 13.3 programs that we have. Our liquidity measures are looking very good. We're staying out of financial crisis. You don't want to be in a financial crisis on top of the pandemic, and so far we've avoided that. So all of that is looking very good. So I think it's steady as she goes for the Fed here.
Quite the opposite. Record highs every day here. What about the permanent damage? We just reported on some of the layoff announcements, even from strong companies that are doing well, like a Salesforce or Nike or Coca-Cola, taking this opportunity to reset their businesses and announce more structural layoffs. How are you thinking about how much damage is going to be done permanently that will not come back when we have a vaccine and when the economy snaps back?
Yeah, well, I'm worried about it like everyone else, but I also think that, you have a big disruption like this. You should expect businesses to be reexamining their models, their positioning themselves for the future. And, I'm not surprised that you get a big rethink in some of these industries. Even successful companies want to rethink where they are and how they're going to position themselves going forward. I wouldn't say, all of that is bad news necessarily. Obviously, if you're the person that's laid off, that's bad news. But if you're thinking about how can you keep the firm competitive going forward, that part could be good.
It's John Fort, and I'm thinking a lot about small business these days. We've long talked about small business as the engine of the economy, and as I look at the markets, as I look at this recovery, it sure seems like large businesses, especially the larger public companies, are performing better. Are you satisfied with the way small business has been participating or left out of the recovery thus far?
Yeah, I think this is very hard on small businesses, although many of them are very innovative. I think bigger companies, if they have hard driving sorts of managements, they can adopt simple measures. I think that's what's so impressive about the second quarter. You look at somebody like a Walmart able to adopt really simple personal protective equipment, mask wearing, other kinds of safety features, and then run their business and have a great quarter. If you're a very small business, you may not be able to adapt fast enough. Your customers may just be afraid of coming into your store. So I think that they've really borne the brunt here. But they also have fiscal package through PPP and other programs that are trying to reach out and help them. And so hopefully they can copy the things that the essential industries did during the second quarter and adopt those approaches to their business and make sure they get their revenue stream at least up to the point where they can get past this crisis.
Jim, just a final question here. If I know you, you're sitting there thinking, like, where's the bubble question? Well, look out, because here it comes. You said you're going to be easier on inflation or more tolerant of higher inflation. You're not thinking about, and in fact, the chairman is not thinking about raising interest rates. Why is that not a massive green light for people to go out and not just buy good stocks, but buy any stocks, and you create asset bubbles through this Fed policy that create danger and systemic risk to the economy?
Well, one of the things we did in the framework review, if you read through the new document, it has more reference to financial stability. And I think all members to some degree are concerned about this issue and want to be vigilant on this issue, some more than others. But I think I was pretty happy with the way this came out, that we were able to get a little bit stronger statement on the idea that we do worry about asset price bubbles. We are aware that the 2001 recession and the 2007 to 2009 global financial crisis were a bursting of asset bubbles, and we do want to guard against that going forward. But I would also say that, you know, you look at somewhere like Japan, which has had low interest rates for a long time, they really haven't had this same issue of creating a bubble. So this is just something we're going to have to watch very carefully going forward.
Sounds like the weather, Jim. Everybody complains about it, but nobody ever does anything about it. Anyway, thanks for your time, Jim. Appreciate you joining us.
Thanks a lot. Have a good weekend.